Hey, everybody, welcome and thank you for spending your Friday afternoon with us. Or if you're watching this as a recording, for spending whatever time you're taking a look at this to check out this opportunity and get to meet us and learn more about what we're looking at here. For those of you who don't know me personally, I'll give a quick introduction. My name is Jesse Dickens. I live in Denver, Colorado. This is my beautiful family, my wife, Adrian, my two sons, Hendrix and Jameson. Jameson is 3 months old. So if I appear a little bit sleep deprived at times during the webinar, it is because I am. But if you are parents out there, you know that it's absolutely worth it. And these guys right here are the driving force behind everything that I do. And that's the reason why we're sitting here having this webinar. My journey into real estate started as a medical professional. I still am a medical professional. My clinical background is in echocardiography. I've been in echo for close to a decade. I love what I do. I have zero plans of not doing this at any point in time, but I uh, also understand the fallacies um, of the W-2 world and relying on one stream of income to provide for my family for decades to come. Sorry about that. I don't think I was sharing my screen previously. Um, so I got bit by the real estate bug in 2016 when I bought my first primary residence. And I didn't know I had, just started working in medicine recently, a couple of years prior to that, and didn't know what I wanted to do with real estate, but knew that I had to be a part of this in some kind of respect. So it started a long journey of education. Read every book out there on real estate, every blog, listened to every podcast, and I was stuck in this state of analysis paralysis. And then when my first son was born, it completely changed that. And within 2 months of that taking place, I bought my first investment property, joined a mentorship program, and just kind of hit the ground running. This is actually a picture of me closing on a property, signing loan docs on my lunch break back in 2022. And sometimes you just have to get creative and find a way to make it work. This is a property that we're actually closing on next week, our first apartment building here in Colorado, which we are extremely excited about to start building a local portfolio. We focus on value add properties. We take properties that look like this and we turn them into something like this with some reconfiguration and some time and money that has not been put into it in quite a while. So I just wanted to give a very quick overview of my background, my journey, and what led me to real estate in the first place. But without any further ado, I would love to jump into the real reason why we are hosting this webinar, and that's to talk about the opportunity that we're currently working on. It is a short-term rental fund. I have my friend and partner, Steve Kafagi, here with me, and we'll get to him here in a second. And just happy to share this opportunity with the rest of my network. So just a high-level overview of what we do as commercial operators. We find, negotiate, and fund these properties and then operate them. And when we find big enough projects, we can bring in outside investors or limited partners or passive investors to bring capital to the deal to invest alongside of us to build a portfolio of their own passive income. So what comes with that is that we are the operators and the capital partners are just that. They're capital partners. They have no active role in the day-to-day responsibilities. They get to enjoy the cash flow, the equity growth, the tax benefits. They are not signing on the loan, and you get all of the benefits of being a part of these types of projects. So that's just a very general overview of the structure of how these deals are put together and why they are really advantageous to high earning professionals. Most of my network comes from the medical field, people that I've worked bedside with for many years that don't have the time or energy to be a landlord, but want to enjoy the benefits of real estate investing. Just a couple of pictures of this is a property that was purchased in this portfolio. It doesn't look horrible the way that it is. This is how we find properties, and this is what we turn them into. This is the exact same property. So that's just a kind of a quick overview of what we do, and we're going to get much more into that as we go through this. So I'm going to turn it over to Steve to handle the next couple slides and introduce himself.
Thanks, Jesse. It's been a privilege working with you and the team, and think it's going on about 2 years now since we've been working on this. Our first portfolio, now our second portfolio. And as folks can see on the screen, we're actually even a little bit higher than this number as of today. We're actually right under $5 million in cash flow distributed to date. So that elusive $5 million target is beautiful. It's an internal goal we've had, and our next one is going to be what, 10, as we kind of closely get there. But we've acquired and helped folks acquire and renovate and design hundreds of properties at this point. To the point where we're getting pretty good at it, and so this isn't our first rodeo. Our team is very much experienced in the space, as you've seen and as others have seen, and we're very excited to kind of see where things pick up. So as you'll see in the following slide, our reviews from folks who have stayed on our properties, what they're able to do and what they're able to see. And Jesse, if you're able to go to the next slide.
Sure.
Our team, the news, the media, you can check out some reviews, both from investors as well as guests. For example, some of those images you see here from Airbnb are what guests are saying. Some of these are investors, and even some newsworthy articles. So let's talk a little bit about our strategy here in the next slide. And in short, our model is acquire a bunch of single family homes, turn them into a institutionalized portfolio of short-term rentals. We're going to cash flow those homes as we continue to hold them as short-term rentals. And a big thing that we do is we typically buy call it like a 4-bedroom home that we turn into a 5, right? As Jesse kind of hit on that value at the beginning. So adding intrinsic real estate value and then collecting the cash flow from that property over the next foreseeable future in the next 3, 4, 5 years as we hold it. And then we're really positioning this portfolio for a sale based on its revenue, right? You wouldn't buy or you wouldn't pay the same for 2 homes next to each other. One that's doing double the revenue is the one that's to the left, right? So that's kind of our thesis, is that homes that do more in revenue will be worth more in the future. Very logical, and that's definitely our approach there. Our second fund today is right at that $37-40 million number. That's the one that's open for investment. Our first fund closed right around 37 million back in the day as well. This current fund has a little over 60 properties. We're now actually, believe it or not, I want to say we're almost to 8,000 reviews or something along those lines. And so we've hosted, if not tens of thousands, but probably hundreds of thousands of guests within our homes. And we continue to do that across 9+ markets with national scale. Jesse and I were just chatting about how over the next 2 weeks, I'll be traveling to our top 4 markets and getting some owner's eyes on those, and that should be fun. So, our performance and the way you should really think about this portfolio is really what you would probably experience with an ETF. And again, for clarity, this is not an ETF quite literally, but the feeling of what you will experience in this portfolio is an ETF, right? We have seasonality, we have ups and downs. We have months where demand is through the roof, and we have months where, we know it's a break-even month. That is very much part of business. But there will be a consistency, as you can see here. The vast majority is green in terms of what we expect. So expect to have ebbs and flows in investing in generally anything that you do put your money into. And so our team very much, while I'm the one here representing us today, I couldn't be more proud of the team that we have. Ex-tech, ex-real estate, comes from industry. We have decades of industry-leading experience from companies like AirDNA on the advisory side. Our head of data and our fractional head of data is literally known as the Airbnb data guy. Mick, who's our head of asset management, comes from Vacasa. Josh, who's our fractional construction and renovation and design head, right, comes from D.R. Horton, used to scale single family homes. Our head of revenue, Austin, is a golden child when it comes to the pricing industry, as they call him, when it comes to driving performance. And there is a slide in here I believe we'll talk about in terms of our performance later on, but a fantastic team behind this, and really one of the best in class for what we do on a day-to-day basis. So with that, I'll kick it back to you, Jesse.
Sure. It's just such a pleasure to get aligned with a team such as that with TechFester, and just a little bit of context of how I got connected with them in the first place. I attend some real estate conferences from time to time, and I was at a conference last year in Louisville, Kentucky, back in February of last year. watched a gentleman who was on that previous slide, his name's Sam Silverman, present on a topic around different vehicles for investing in real estate deals. And I was super intrigued by the platform and the content of what he had discussed. So I connected with him in the hallways. We exchanged information. We connected offline after the conference. And there are just times when you feel completely aligned with an individual and you know that you want to work with them and you can tell that they're the same core values. And I had that experience with Sam. Immediately asked for more information on the project that he was working on. He sent it over. I fell in love with the deal itself and all the different uh, ways of risk mitigation, specifically in this part of the market cycle. We look for risk mitigation just as much as upside in a deal. And then I got connected with Seif and Sabrina shortly after that, and just knew that there was an alignment of core values, like I said. So honesty, integrity, communication are the three big things for me that I have to have. And then in the deals that I get into, if they're not going to be in state, I have to have one of two things. I have to have either boots on the ground in those markets or vertical integration with the team or a combination of the two of them. So, and we'll get to that again later, but just wanted to share a little bit about how we all got connected. So my other partner who's not on the call is Suja Shyam. She was a part of the deal last year or 2 years ago, short-term rental fund one with Seif and Sam and Sabrina. And when I connected with her, talked about her experience in the deal and the performance of that deal, I wanted to join with someone that had worked with these guys in the past. And I found that with Suja. She has a very long history where her W-2 before she left and has focused on real estate full time was in commercial underwriting. And she is super sharp, a fantastic person, and has been great to work with. So turn it back over to Steve from here.
Yeah, and we absolutely feel the same working with you and Suja. It's been a pleasure. So excited to talk a little bit about the asset class. So short-term rentals, many of you may know these as Airbnbs, are what we do and what we only do. And so for us, what is a good buy for a short-term rental and what do we believe the future will hold? First and foremost, it's typically larger homes, right? So you'll find in our portfolio, the vast majority of our homes we own are typically 4 bedrooms and larger, if not 5 bedrooms and larger, right? And these are things that we're adding intrinsic real estate value. We're winning on space and amenities. We don't compete with hotels, right? So if imagine yourself as a group of 8, 10, or 15 people, for you going to a hotel or if you have kids, it is not a great experience. It's not built for that type of thing. Now, if you're a couple, if you're traveling for business, you got to be in the city or you want to be in the city, you want to be by the big lights, that could be an option for hotels. And in fact, when I travel with my wife and it's just us, sometimes the hotel gets a job done in a beautiful way. When I have my 2 boys that are, one is 3 and one is coming up on 2, hotels don't do a great job, and anyone who's got kids or people want to remain active or a large group knows exactly what we're talking about. Now, financially, we like short-term rentals over long-term rentals because of the cash flow, the revenue, the upside that a short-term rental has, as well as the fact that it's pre-institutional. There's a lack of good operators in the space, and we're dealing more and more with mom and pops. And so, as Jesse can probably attest to, or anyone who's been in the space, when you can compete with mom and pops, that represents an opportunity to outperform said mom and pop, right? And when you're dealing and working against companies like BlackRock and Blackstone, it becomes infinitely harder to win, right? They can out talent you, outspend you, outgrow you, drive down to zero because they're incredibly financially backed typically. Against mom and pops, typically a little bit of elbow grease goes a long way, as the saying says, and we have quite a bit of elbow grease and technology behind what we do. So as we kind of transition into here, the next slide, let's talk a little bit about what those mom and pops typically do and what their properties look like. So this is what we like to call as the dorm room competitor, right? And so mom and pops typically don't design very well. They're typically designing and amenitizing for themselves. They typically lack professional management on either the revenue or the property side. They're typically not thinking about expenses to the intrinsic levels that we do. They're not thinking about economies of scale or probably lack it because your average operator on Airbnb has less than one property, right? Or essentially one property, somewhere between 1 and 2. And they certainly don't have the talent or the team behind it for what we're doing. So these are the areas that we believe we can win on a continuous basis. And when you look at some of the properties that what we're able to put out, our properties look like this. And the first thing that you probably that might come to mind is words like cohesive. You look at this, you're like, wow, like it's thought through. And I know that's such an obvious detail when you look at something after the fact, but most operators don't think that way. Most owners don't think that way. It's their second home. They're operating it on the side for a little bit of money, but our rentals are primed with data in every single market to outperform through and through. Or for example, if you walk over to our Florida market, custom bunk bed slides that we build in, high use amenities like basketball and pickleball courts, right? We have it. We even tested out experiential type experiences like this kids play area, which feels like you're, for lack of a better word, you're in your mini Disneyland. And so while this property looks like this today, let's take a look at what it used to look like in the past. And what you can see here are some pretty major differences just from this overhead shot, right? So first and foremost, brand new roof. We removed the pool gate, expanded this view, and people buy and book on sites like Airbnb through visuals and photos. So we wanted that aha moment when you're scrolling, you're like, wow, that is a spot that I want to go to. Even notice how each area is connected, right? You have the mini golf up in the top left with that paver walkway. Even as you go to the right, there's a paver walkway behind those loungers for the fire pit area. And as you come down to the basketball court, you have that small walkway. Those details matter in the cohesiveness of this image and the way it lands for an individual. Removing the pool gate, a lot of people would say, well, why would you spend 10 grand or 5 grand to remove the pool gate, right? Why would you just keep it, especially if it's in good condition? And I can't recall if this one was in good condition or not, but it's because of this shot right here. I can't get this shot if that pool gate is here, right? I wanted to open up the space. Another thing we did here is the original fence on the bottom was actually closer to the home, but we realized through the survey that we had more space and we could actually fit in a basketball court. So it's understanding those types of things and the engineering and the architecture and the design. And of course, the inside of the house looks good too. This home will do close to $250,000, if not more, in annual revenue. Or this home in Scottsdale, which again, if you look at that overhead photo, looks incredibly cohesive. This was, by the way, a dirt lot outside of the pool when we bought it. So fully custom mini golf area, pickleball, basketball combo, kids play area, fire pit area, all those types of amenities. And fun fact, in every market, we have data as detailed as what type of design of a mini golf structure or what colors of a pickleball court might actually do well in said market, right? So we test all of these types of things out. And sometimes we take hypotheticals and start putting them in the market to test. And sometimes we have hard data that also tells us how those things are going. And then you go back to another part of our Florida market. You have a couple of homes here in the Clearwater, West Palm Beach area as well. And you can see these experiences in the top right. You have this very beachy vibe in West Palm Beach that you want to invoke in that type of market. And then towards the bottom, you have really simple, elegant design. You have a golf simulator, right, that we built in one of the garages because that was a hypothesis for us is, would this amenity work? And I can tell you for a fact that that amenity clicks and books revenue at an unprecedented pace. And here's a property from our first fund. I think this is a great example of what we do to a home and why we can out-operate other folks. This was actually an existing short-term rental when we bought it. It's one of the few, if not maybe the only one that we did in that capacity. They were doing about 140 grand a year in annual revenue for the last 3 years as an operator. At least that's what their financials showed. And in our first year in this property, we did over 210 grand, right? Now, why is that? There's better design, there's better amenities, right? But most importantly, it's the culmination, the domino effect of 1,000 little decisions that came together, right? It's the design, the amenities, the placement, the avatar, the amenities in the back, the types of color scheme that we went through, the pricing strategy, all of those types of things naturally contributed. And then when you compare our properties, for example, like this one of how we compete in the market set, right? And this next slide, we'll talk a little bit about how we compete against, for example, Vacasa, which is the largest property manager in the space. Jesse mentioned being vertically integrated, and we'll talk about that here in a second. But because we are vertically integrated and because we do manage our own assets, and that's all we do, by the way, we do not manage any assets for anyone else. We own, we operate. If we don't own, we don't operate. right? And that gives us a really, really strong advantage in the market because we lack any emotional attachment to the homes. In short-term rentals, over 40% of property managers report that their owners restrict them from actually driving elite revenue at their home because they make suggestions like, please don't rent my property out for less than X. Please don't allow pets. Please don't do this. And when you start adding all these rules, that right there is what we call as an inefficiency in the marketplace. And that allows operators like us who lack the emotional attachment to make logical decisions and therefore simply win, as you can see here on data, which we're driving well and above. In the most recent quarter, I think we drove damn near 60 or 70% more revenue than our competition in our second fund, which is a combination of course, occupancy and rate. Now, part of the way we do that, of course, is our vertical integration. And this next slide is what we call our STROS, or our short-term rental operating system. We, in our early days, did not expect to actually do this, fun fact. We said, hey, we were going to hire the Vacasas of the world. And what we learned very quickly is if we want elite performance, we needed to own and operate our own assets, right? We cared too much. We care about different things than typical property managers. And we wanted to deliver and create and craft an experience that was difficult to replicate for most other property owners and managers. And from our acquisition strengths to everything that we're able to do on a day-to-day basis, these are the things that are able to drive that extra 20, 30% of revenue, which a lot of that is just pure positive net cash flow at the end of the day. And so if we didn't build that, here are all the things that typically everyone else would have to figure out and solve for, right? Finance and accounting. How do you actually run finance and accounting, reporting and bookkeeping for a portfolio of this size? How do you figure out acquisitions across the country? How do you build data sets, right? Like we build a lot of our own custom data sets and tools in partnership with our advisors. For example, the folks at AirDNA, Jamie and Scott have been fantastic. How do you think about expenses? How do you think about driving NOI up, right? It's a combination of both revenue up, but also expenses down, right? How do you think about permitting, right? And regulation and compliance? How do you think about operations? How do you think about renovation management? Right. And we've negotiated better expense ratios on those types of things because of our scale. Like we use a certain type of paint. All of these types of things allow us. And if anyone's ever done a renovation on a 300 unit apartment building, you know exactly what I'm talking about because you're like, well, I'm going to do white paint. I'm going to buy a lot of this white paint. I'm going to get my economies of scale down, and you negotiate that up front. We even negotiated our utility costs down in one of our markets by over 40% on electricity because we call them up and say, hey, we have 40 properties in this market. Can we pre-buy electricity for the next 2 years? Fun fact, something you can do, but you can only do it if you have economies of scale. And those are some of the things that we've done. Now, where are we buying? Right? So what does a typical buy look like? And it looks like this: $500,000 give or take home. That's going to drive somewhere between $120,000 to $150,000 in annual revenue. Right? It's going to be elitely set up. It's going to be elitely designed, and more importantly, it's going to be operated at an elite level over a long period of time. And so, we've also built technology in-house, right? And that really allows us to better understand what to buy, where to buy it. And as you'll see in this next slide, gives us a lot of insights, right? How are we thinking about IRR on a certain type of hold? What are the expenses projected for this, right? Everyone always talks about revenue. We're thinking about expenses. And, because we have a blended portfolio across the country, I can tell you we have properties in some markets that have incredible expense ratios. And we have other properties in other markets, which you'd look at the expense ratio and you probably second guess yourself, but we're buying it at such a great basis that the cash flow is already naturally optimized, right? And that's really what we're optimizing for, is that yield and overall equity growth, right? Just because something has a higher expense ratio doesn't actually make it a bad buy. It's also, well, how do you think about seasonality, diversification in a portfolio? And we have a 16-point strategy, which all of these things are naturally tied into. How do we think about average daily rate? In fact, you see $200 here. We're more than double that right now as an average, right? That was initially our goal, is to not compete with hotels. And we are averaging well in excess of $400 average nightly rates across our portfolio. We remain under the $750,000 price point on an average in our portfolio per home. We're looking at seasonality, diversification in general, right? The types of travelers, the types of seasons, the types of assets, the types of markets, geographies, regulation, risk, right? Making sure that's hedged as quite efficiently as possible. And we're looking for adventurous experiences that are really difficult to replicate in a lot of areas. And in many cases, our homes are the destination because they host groups. People come to our homes because they want to visit the home and stay there and relax and have fun. Oftentimes, people think about an Airbnb as, I'm going to X city, I need a place to stay. Most of our guests actually think of like, oh, I want to visit Scottsdale. They end up going to our home and they actually don't end up leaving as often as they would think because they have a lot of amenities there on site. So with that being said, I want to kick it back over to Jesse, who can talk a little bit more about the interest fees of the investment itself.
Sure, I'll let you catch your breath, see if that was quite a bit, but thank you. That was awesome. So just looking at the basic structure again of how these are put together, every deal like this is going to have a minimum investment for this deal, and pretty industry standard is going to be $50,000. It is a 5-year projected hold period. We really could see this once the entire portfolio gets seasoned in years probably like 2 and more like 3 and 4. That's when we can look at an exit, but we think realistically a 5-year hold, which is what most syndications and funds strive for anyway, is a very realistic time frame for this. The tax benefits through cost segregation will, I believe that we're going to talk about that later. If not, we can connect offline. The tax benefits will pass through, 100% of them will pass through to the investors. As capital partners in this deal, you will get to receive about a 20% projected paper loss on your K1, which is your tax documentation for an investment property. And you would have to work with your CPA to see how you can apply that to your taxes and your adjusted gross income. But it's always great to show losses on your tax returns, especially when you're cash flow positive. So we kick out quarterly distributions. Usually it's about a 6-month period. It's about 2 quarters, depending on when you jump into the fund, to where it's a 6-month period of ramping up to be able to send out distributions. And after that point, quarter after quarter, since distributions have started within this fund, we have not missed one and they've been on target. Our average cash on cash that we're looking at is 8.5%, very much trending in that direction. The total return, when you include the cash flow and the sale at the end of the whole period, is going to be 19% average annually. And to simplify that, that's basically saying if you have a $100,000 investment, it's going to be at about a $95,000 profit return at the end of that, on top of your $100,000 coming back to you at the end of the sale. We have not structured a refinance into the underwriting. If rates do drop, and I think there's a very general consensus that rates at some point will drop. We don't know when that is. We don't know to what extent. But if rates drop and it makes sense to refinance some of our properties into a lower debt product, we will absolutely look at that. But again, we don't underwrite to that. So we would only do that if that would juice the numbers up and create better returns for you guys and us as well. And then also just as Steve talked about, the diversification of being in multiple markets with different pieces of seasonality and different pieces of upside to it is a huge part of this deal. So, and again, going back to the structure, we do a preferred return, meaning that the first 8% of all cash flow that comes in goes directly to our passive investors. The first 8% will always go to them. In year 1 of these types of deals, you generally do not hit that 8% preferred return. So that just gets accrued into the next year, and that you will always get made whole on that preferred return before any other distributions are kicked out. After that 8%, then there's a 70-30 split where the passive investors get 70% of everything over 8%. The general partners get 30% after that. And as I said earlier, it's passive from day 1 and every day on. After that, we do the work, you get all the benefits. It's a perfect marriage. This is basically another slide showing just more of what I just talked about. And one thing I'd like to highlight here is the ramp up in cash flow. So year 1 around 4%, year 2 8%, year 3 9%, and years 4 and 5 projected 10% cash on cash, which is fantastic. I have come prior to this deal more from the multifamily space. This is cash flow that I have not been able to find in any of the markets that I'm involved in the multifamily space. And that was one of the things that really drew me to the short-term rental space. And then just to talk about the general bell curve of this type of investment. So when we first bring capital in, for each funding round, there's a ramp up period where we are finding, purchasing, renovating, and furnishing these properties, and then launching them, getting them on Airbnb, VRBO, and it takes a little bit of time to do that from start to finish. So the beginning of the process is kind of slow, and as we really ramp up towards really year one, and really by the end of year two, that property is really stabilized and performing and has a track record, has lots of reviews, and is kind of humming along. So we'll be in that period for a stretch of time, and then as we wind down, we'll start moving towards the exit, where we're looking at an institutional type buyer of either a family office or a private equity firm that wants to buy the entire portfolio and have one big exit. One of the beautiful things around risk mitigation that I mentioned earlier is that that is the plan. And if at any point we wanted to sell off any individual assets, we have the ability to do so. We do not plan on doing that, but if there's a reason to do that, if there's an unbelievable offer that we just couldn't turn down, that would juice up the cash flow even more, we can look at that, and there are no prepayment penalties. None of these loans are cross collateralized. So we have the ability to do that. So different properties, as we're buying properties continuously, going back to the beginning of last year through this year, different properties are going to be at different points along the curve as we go. But that is the general process. So I'll kick it back over to Steve.
Yeah, and I think you hit on a couple great things there, Jesse. And I think the first thing is, in investing, one of the first rules is buy well, and don't lose money on the buy, right? You can't control everything that happens after. So first and foremost, when we're typically buying a home, we're buying it usually for like at value or right below value, right? Meaning getting a little bit of additional equity on that front. You're typically not getting a home 30% below value in the single family space, right? It's typically highly unlikely unless it's quite literally a piece of shit. And it's a flip off market, those types of things. Secondly, we're adding a lot of equity, right, through extensive renovations right on the front end, and we're using cash for this. We're not financing that. And the reason that's important is that's intentional. We could finance renovations, but then that would also increase the risk profile, in our opinion, on the property. And so we're making the selective decision to finance the home, but not finance renovations or furnishings or any of those types of things. And these are furnishings and renovations that are, value adding. We're adding square footage to the home, legally permitted, right? Making that home instead of a 2,000 square foot home, a 2,400 square foot home, taking an empty backyard that's a dirt path and landscaping and creating a lot of value for amenities. And whether it's an Airbnb or someone's home, they would very much value having those things in their yard. And so that really creates a great loan to value basis. And something that Jesse mentioned is that all of our debt none of it is cross collateralized today. And one thing I just wanted to clarify is some of our debt do have prepayment penalties, but I think what Jesse was referencing to is in the event that we were to sell, or do a refi or any of those types of things, often those things can be negotiated away, or you would just simply wait those things out, right? We do expect the cost of debt to come down over a long period of time, but that's not something we actually underwrite for. So if debt comes down and we're able to refi down to a lower rate, that could be huge. That is something that is actually fully expected, but it's not something we put in our underwriting, right? The main thing I would actually pay attention to is what is our DSCR, our debt service coverage ratio. Now, why is this important? When you take out a loan, really what the lender is typically looking for is, can you at minimum cover the cost of debt? What they're looking for is usually a 1x to a 1.25x ratio on your cost of debt. Ours is between a 2 and a 3. Meaning for every dollar of debt that we have, we're generating between $2 and $3 of what is after expenses, gross profit, gross revenue, however you want to describe that number. And that right there is essentially what we would call our NOI. And so we have 3 times the NOI versus our cost of debt. And because we have that, right, it's going to allow us to be very aggressive in a time of a refinance if need be. Right? If rates come down and property values increase, our NOI should be healthy enough that we can actually refi down to that 3, 4, or 5% type rate, right? Be able to lock that in, free up even more cash flow, and then we can decide if we want to do a quote term refi, or if we want to actually pull money out. We can think about what those options are going to look like at that point in time. So as we also think about not just the cost of debt, is can other people compete with us? Because competition is something that you have to always be mindful of, right? Whether it's today or sometime in the future. And the short answer is people can try, but it's going to be very, very hard to build infrastructure, operations, scale, a team of this caliber, especially with the data insights that we have. We're in an industry that's very much brick by brick. The only way you kind of get through it is you kind of got to lay every brick down and get through it. So every brick that we've already laid and every brick that we'll continue to lay in the future, there's really no shortcut to getting through that. And so that's going to give us an unfair advantage relative to everyone else, even if they do decide to enter the market. And so let's talk a little bit about taxes, right? And so first and foremost, none of this is going to be financial advice for myself or Jesse. But the good news here is Uncle Sam allows us the ability to do what's called a cost segregation study on every single home that we buy. And what this means for you is that you're able to take what's called bonus depreciation, which is essentially writing off the yield, the income, the growth equity from this investment through your taxes, right? Now, this is going to affect your passive income, not your active income, unless you qualify as a real estate professional and some of those other things, right? But for the vast majority of people who have a W-2 job and, you know, being able to get $5,000 in cash flow, for example, from an investment like this, what's cool about that is the vast majority of that is going to be really deferred taxation. And that's going to allow you to compound on a faster basis, right? It's beneficial tax treatment. You're a K-1 owner. There's a paper loss. And all these things are going to allow you to realize more of your net gain. And so coming into another big benefit of the portfolio is you can actually stay in any of these homes and save somewhere between 10 and 30%. I know, Jesse, you talked about multifamily. I know we're both aware of many other asset classes like mobile home parks and car washes and other things that people invest into. I don't know if I know of any other asset class that allows you to actually use the investment for your own pleasure. And you can bring your friends and family. Now, it's not free because it's an investment first, but you're able to save on those direct booking costs that we would have. So it's on a net basis the same what the fund would have received to begin with. But it's a perk. Use it, and it adds to your lifestyle. It's also great because we know our investors will take care of these homes more than anyone else, right? Naturally, because you are a direct owner. So we encourage you to use it. So to kind of recap a little bit here, we've really formulated what I'd like to call the best team in the space. I think we have industry-leading technology and tools that we continue to iterate on a day-to-day basis, and we build them if anything new comes up. We have scale. We've done this over 140 times, one way or another across the country. The good news when I compare our second fund to our first fund is they're noticeably better, right? Because you've just done this 100 times. Think of an eye doctor or a surgeon who does 100 open heart surgeries. You would imagine that over time he gets a little bit better, right? Time and time and time again. Very much why you seek the heart surgeon who's maybe done this 100 times and maybe not the first. We're vertically integrated, as Jesse mentioned, and so that is a huge advantage to us. We control a lot of things. There's no red corporate tape that we have to get through. There's no vendors in many cases that we can't really push and influence, right? These are advantages that we have. The market, lack of professionally operated short-term rentals, and the fact that we use a lot of data and design-driven decision-making allows us to win on a day-in and day-out basis. So these are many of the reasons why we're very much excited about the opportunity. And Jesse, to kick it up back to you, I also want to thank you for the opportunity to come and speak to your community today.
Thanks, Steve. I always appreciate your partnership and how eloquently you can speak about and how passionate you are about this project. So yeah, to wrap things up, if you have any interest or any additional questions about the project, please feel free to reach out to me directly. We do an investing round every 2 months. So we're not sure how far into the year we're going to go, if we're going to go the full year or not, but we are launching a new funding round starting tomorrow, and that will be open for 2 weeks. So please feel free to reach out. Would love to chat more, connect with you offline to discuss it. And I hope everyone has a fantastic weekend, and please feel free to reach out. So thank you guys, and hope to talk to you guys soon.